Welcome back. You're watching Traders Corner, and joining me as always is Garth McKenzie, founder and editor of Traders Corner. Garth, welcome.
Hi, Julieta.
Garth, I hope your nerves are intact because it's been a harrowing couple of days, starting with US markets pullback on Friday night. Monday night was pretty steamy. And then today it looked as if we were going to go really deeply into the red. We did at one point, and then we recovered. So how is this affecting you and your positioning in the market?
Yeah, that's right. Well, yeah, I mean, nerves are quite shot at the moment because it has been a very, very unpleasant week. We've seen this market declining more than 6,000 points since we sat here last week.
Yeah.
So it's been a very, very violent pullback to the downside on our market and obviously on US markets. I was up a lot last night. Usually I'm only awake because of my little new son. And he keeps me awake at night sometimes. But last night he actually slept like a baby, and I was the one up almost crying because this market has been terrifying. And it's not, we're not out of the woods yet. And I think the reason why why the nerves are quite shot is because that put spread option structure that we did for the show last week is looking a little bit in dangerous territory at the moment. By and large, I'm okay. I think in gut feel, I think we'll be okay here. But the reality is it's pushed into the danger zone. So let's just explain that and unpack it a little bit. I mean, the chart of the top 40 is up on the screen there at the moment, and you can see the very violent sell-off that we've seen over the past 8 trading days. On the right-hand side here, we have the payoff profile of that put spread structure. And really it works below 54,000. It makes its maximum money between 52,500 and 51,500. But what I always say with these structures is that there is a danger zone. And you need to be cognizant of that. It's not as if it's like a short position where if the market collapses, you're okay. If in a market crash situation, these things can lose money, and they can lose a lot of money. I structure them in such a way that we look for some sort of a pullback of maybe between 5 and 10%, and then we'll look to benefit from that. When the market starts collapsing below those sort of levels, then it starts to get quite scary. And that's where we are at the moment. So below 50,000, this structure starts to make losses. It loses 10 Rand per point below 50,000. Now, that might not sound like a lot, but this morning, when I woke up, IG markets had our theoretical open on a market at 47,000, which it means a loss of 30,000 Rand on this option structure for us as at that level. Look, fortunately it has recovered a little bit. You can see the massive gap to the downside that we saw there. I mean, I've never seen a gap down that big on our market ever in my career. It was a huge gap of 2,000 odd points. Yeah, it was huge. And of course that does push us down into the danger zone on the red on the right hand side over here. It's recovered. As we sit here now, it's trading at about 49,600 or thereabouts, but it's very volatile. It's moving around aggressively. So we need to monitor this very, very carefully. For me, it's kind of damage control at the moment, trying to keep a cool head and trying not to panic.
I mean, the irony, of course, is these are supposed to be the safer sort of short positions that you take against the market, and because it runs out to March. And that's really, I mean, if the market actually recovers and ends in your safe zone or sweet spot by March, is that okay? Or can you just end up being closed out before it gets to that point? No,
look, if it expires in our sweet spot, we can still make money out of this trade. And I must say there's a part of me that is still relatively confident that we will. I think we've had a very big crack to the downside now, and I'll show you some slides looking forward now, what I see potentially happening and why I still do have a relative amount of confidence in this trade, albeit that I'm quite nervous about it right now. This is a weekly chart of the top 40 spot index. So being a weekly chart, every candlestick pattern represents 1 week's worth of trading action here. You can see this goes back to 2014, where we've had that sideways move for 3 and a bit years on our market. We had a big breakout in the middle of last year, and you can see that we've now come back, and we've come back very, very quickly. We're now retesting that breakout area where there's some support between 47,500 and 48,000 on our top 40. Now, provided we can hold that sort of support area and reverse up off there, then I think there is a chance that we'll see a little bit of an oversold bounce and a recovery of some of this drop over the next month or two, which that's where I get my sort of cautious optimism from. at the moment, but it's, we need to see the market finding that support and reversing up from there.
Garth, before we move on to US markets, which is, I suppose, to some extent the source of, well, certainly the pain that we're experiencing now, I mean, isn't that a classic double top formation there?
It is, you could say in hindsight, yes, it is a double top. You see it there, and then when it starts to break below the bottom or that middle point of the double top, that's what validates it, and then you usually take that distance and you project it down, which gives us a move approximately to where this support zone is that I'm talking about now anyway.
Yeah. Moving on to some other markets, the S&P. I mean, I suppose the irony is that we were saying the market had gone parabolic. It had just been almost unnaturally strong, and now there's a crack and everyone's panicking. But it's not, it doesn't take it to I suppose unreasonable levels if you consider the pullback in the context of what the market has done over the last 18 months.
Absolutely, no, that's right, and that's why I think a lot of financial news networks I've seen today, they're just calling this a correction, and it's a healthy correction and what have you, albeit that it's been pretty swift and violent. This is a weekly chart of the S&P 500 here, and just to put this in context, so we're looking also at 3 years worth of trading history here. You can see the upward trend that goes back to early 2016, how it joins all the lows since that point. Now that comes in at around about 2,600 on the S&P 500. So provided we can hold that area and bounce off there in this week, then I think it's okay. But I'll show you in slides to come now why I still think we just need to be a little cautious looking further out. But I do think in the immediate future that 2,600 area looks like quite an interesting area of support. And I would like to see ideally the market beginning to find some stability around that area.
Yeah, well, talking of stability, I suppose the VIX is anything but, and I know that's your next chart.
Yeah, so the VIX is the Chicago Board Options Exchange Volatility Index, and it measures market fear effectively. Now, last year we went on and on many times about how this VIX index was at multi-year lows, the lowest we've seen since 1993. I did also say at some point during the year that it was unlikely to stay that way forever, and that at some stage, usually very low volatility like that precedes a sudden pickup in volatility.
And
well,
how?
Boy, have we seen that. So last night, the VIX index rallied 115%. You can see the close there was 37 on the VIX. I mean, it had been trading below 10 just a few weeks ago. So a very, very violent spike up in the volatility index there.
Yeah. And Garth, I mean, if we consider this in the context of what has happened in markets when there have been corrections or crashes, I mean, how do you think this sort of squares up?
Yeah, well, I want to show these next couple of charts to illustrate just, I think, some points to flag looking out in the next month or 2 or 3 even. Because I've looked at a lot of prior market bubbles that then burst. And it's debatable whether the US market was in a bubble or not. Some will say yes, some will say no. But I think there's certain similarities that we can draw parallels between what I'm going to show you here and what we're seeing on the S&P 500 now. And I just want to alert the viewers to this for the next couple of months to be aware of. Okay. Because I'm not saying we're necessarily going into a new bear market, but remember that every bear market starts with a correction, and then ultimately it follows through to the downside. So we don't know at this stage whether this is the start of a new bear market or it isn't. But I'm just going to put out a few flags and a few pointers for people to look at and watch in the weeks and months ahead in this context. So we look back at the dot-com bubble, the NASDAQ, one of the most famous bubbles in our lifetime, which burst spectacularly in the year 2000. And what's evident in this, and you'll see it in all these other charts, is that there's a pretty consistent pattern in terms of how these markets crack and how the bear market then starts thereafter. So you have a blow-off top where things just go up in a crazy fashion, and then you see this massive crack, and I've labeled them number 1, 2, 3, and 4 in all of these diagrams. You see a big crack to the downside, very nervous markets, etc. Then you see a rally, but the rally is not strong enough to rally back and make a new high. That's when you need to be careful, because then that invariably tells you that there's more weakness to follow. And you can see on the NASDAQ thereafter that we saw the sell-off that followed in the months and years ahead after that initial crack. So just keep that in mind. Let's have a look at another one. This is the Chinese equity market bubble that burst in 2015. This was at a time when there were stories of Chinese grannies and housewives and whatever going to trading arcades and playing the stock market, and it always was going to end badly for them, and it did. You can see that it went into, again, a blow-off phase in early 2015. It then had a massive crack in the middle of 2015, a rally that was a bit of a feeble rally, couldn't make a new high, couldn't even get close to a new high in that case, and then the sell-off continued thereafter. Let's have a look at another one. This is the Rand-dollar exchange rate. So slightly different instrument, but I think the trading psychology and the pattern of trade here is pretty similar.
Yeah.
This was the Rand-dollar with Nenegate in late 2015, early 2016. And what you saw was, again, weakness in the Rand, but eventually a big blow-off move, and then a significant pullback, a rally which was unable to breach the prior highs, and then you see the fall away that then follows thereafter. Yeah,
although that's quite sort of an interesting, because it's kind of an inverse chart for us, because actually we would look at that almost in a positive as the strengthening of the Rand.
Correct, we would, but I suppose you could look at it and say, well, the asset that we're talking about here was the dollar, and the dollar blew off in value to the upside and then fell away in value. The pattern is the same, and the thinking of is very much the same, as you can see.
And I suppose there's a danger because the four initials are BFTD, BTFD, excuse me, and I'll let viewers work out for themselves what that actually means. But that sucks you in, doesn't it? So it sucks in, and I guess that sucks punters back into the market. Then you do see that rally, and then, but circumstances have changed. Maybe people think, actually, the market's overvalued, I want out of here. And then the real selling begins. Yeah,
well, that's it. And that's, I think you're right. So you get that next move up, but if it cannot make a new high, then I think it creates even more nervousness in the markets. The last one I want to show you quickly here is the mania in Bitcoin. This is obviously very fresh in our minds. This is what happened in December and now into January. And the pattern here is identical. What you see is you get a blow-off top that occurred in December, up into the middle of December. Then you get this almighty big crack, which happened in late December. Then a rally, but the rally, although it was a powerful rally, it wasn't able to make even a close attempt at the prior high on Bitcoin, and you can see the sell-off that has ensued since then. So
that's really the key, is whether or not it manages to take out the prior high, and if it doesn't, it generally presages further downside.
Well, this is it. So if we go back to our chart of the S&P 500 here, and this is now a daily chart that I want to look at here, what you can see is that we've had that massive blow-off top in January. It was a very powerful move to the upside. I mean, everything was bullish. I couldn't stop seeing bullish commentary everywhere. And then we've now seen this big crack over the last week, where the market's pulled back pretty much 10% in a few days off its high. Now, what we need to watch for here is to see the rally that follows from here. Is it strong? Does it make a new high? Does it challenge the prior highs, or does it not? Because if it doesn't, then I think we need to be very, very careful for the rest of this year. And that's certainly something that I'm going to be watching in the coming months on the S&P 500.
So what did the portfolios look like then, given the somewhat nerve-shattering events of the last few days?
Yeah, so our South African portfolio, I've just put a theoretical movement as at the market's level when I put these slides together. So it's showing a loss of 6,500 Rand on that put spread structure, which is really not a disaster. It means we're down 6.5% on the South African portfolio. So it's not pretty, but it's not a disaster, and it's certainly not as bad as what it was looking early this morning when I woke up.
Yeah.
So we continue to monitor that, and I'm going to need to just be very cautious about what I do there and how I manage that position. I'm not adding anything. I'm not hedging right now. I'm trying to be as cautious as possible in terms of damage control. And then on our offshore portfolio, things are actually looking a little bit better. We've got that Bear Treasury ETF, and the one thing that has worked out quite well over the last week or two is that US yields have been pushing up.
Yeah.
Bonds have been falling. So that has actually translated into profits for our Bear Treasury ETF that we've done on the show. We're up $130 there. So we're up slightly on the offshore portfolio.
Yeah. Garth, we have to leave it there. Viewers can go onto the email, subscribe for a weekly alert. But thanks as always for joining us on the show. Garth McKenzie is, of course, founder and editor of Traders Corner.